My dear students, welcome back to our channel. Students, in this video I am explaining MBA third semester. Subject Investment and Portfolio Management, first unit. Important short and long questions and answers. Let's start quick revision. First important short question is: explain risk-return trade-off. The risk-return trade-off is a principle suggesting that higher potential returns on investments come with greater risk. For instance, consider investing in government bonds versus stocks. Government bonds are low risk, offering modest returns, while stocks can yield higher returns but carry the risk of market fluctuations. If an investor chooses stocks, the potential for higher returns exists, but so does the possibility of significant losses. Thus, a conservative investor might prefer bonds for stability, while an aggressive investor might opt for stocks for the chance of substantial gains. Balancing these choices aligns investments with risk tolerance and financial goals. First important long question is: explain the investment decision-making process. The investment decision-making process is a systematic approach used by investors to select suitable investment opportunities based on their financial goals, risk tolerance, and market conditions. The process typically involves several key steps. 1. Setting investment objectives. The first step is to clearly define investment goals, whether it's capital appreciation, income generation, or wealth preservation. Understanding personal financial goals helps in determining the investment horizon, which can be short-term or long-term. 2. Assessing risk tolerance. Each investor has a unique risk appetite, influenced by factors like financial situation, age, investment experience, and emotional comfort with risk. Evaluating risk tolerance helps in choosing appropriate investment vehicles, example, stocks, bonds, real estate, that align with one's willingness to take on risk. 3. Research and analysis. This step involves gathering information about various investment options. Investors analyze financial reports, market trends, and economic conditions to evaluate potential opportunities. They may employ fundamental analysis, examining financial health, or technical analysis, studying price trends to make informed decisions. 4. Portfolio diversification. To manage risk, investors build a diversified portfolio by allocating funds across different asset classes and sectors. Diversification helps reduce the impact of poor performance in any single investment, thereby enhancing overall portfolio stability. 5. Making investment decisions. After thorough analysis and considering their objectives and risk tolerance, investors make choices about which assets to purchase or sell. This can involve deciding on entry and exit points based on market conditions. 6. Implementation. Once decisions are made, the final step is executing the transactions through brokerage accounts or investment platforms. It's essential to consider transaction costs and fees at this stage. 7. Monitoring and reviewing. After investments are made, continuous monitoring is key to ensure that the portfolio aligns with financial goals. Regular reviews allow investors to adjust their strategies based on performance and changing market conditions. In conclusion, the investment decision-making process is an essential framework for making informed and strategic investment choices, guiding individuals towards achieving their financial objectives while managing risk effectively. Next important long question is: state the sources for investment information. Access to reliable and relevant investment information is crucial for making informed financial decisions. Various sources provide insights into market trends, company performance, and economic conditions. Here are some primary sources for investment information. 1. Financial news websites. Websites like Bloomberg, CNBC, and Reuters deliver up-to-date news on market movements, economic indicators, and corporate developments. These platforms offer analysis and expert commentary, helping investors stay informed on current events. 2. Brokerage firms and investment platforms. Many brokerage firms provide research reports, market analysis, and tools for investors. Platforms like Fidelity, Charles Schwab, and E-Trade often include educational resources, real-time data, and analyst recommendations. 3. Financial statements. Publicly traded companies are required to disclose financial statements, including balance sheets, income statements, and cash flow statements. Investors can analyze these documents to assess a company's financial health and performance potential. 4. Investment research firms. Agencies such as Morningstar and Standard & Poor's specialize in providing comprehensive investment research and ratings on stocks, mutual funds, and ETFs, assisting investors in evaluating potential opportunities. 5. Economic reports and indicators. Government publications from organizations like the Bureau of Economic Analysis, BA, and the Federal Reserve provide essential data on economic health, including GDP growth, unemployment rates, and inflation statistics, which impact investment decisions. 6. Financial magazines and journals. Publications like the Wall Street Journal, Financial Times, and Harvard Business Review offer in-depth articles and analyses covering market trends and investment strategies. They provide valuable insights from industry experts and academics. 7. Social media and investment forums. Platforms like Twitter, LinkedIn, and Reddit, example, Wall Street Bets, have emerged as sources for real-time news and investor sentiment. However, it's essential to approach this information with caution due to varying reliability. 8. Podcasts and webinars. Many financial experts and organizations offer podcasts and webinars discussing investment strategies, market updates, and personal finance tips, making them accessible learning tools. In conclusion, utilizing a combination of these diverse sources for investment information enables investors to make well-informed decisions, adapt to market changes, and build strategies tailored to their financial objectives. Next important long question is: explain the factors to be considered during investment decision making. When making investment decisions, several key factors must be considered to ensure that the chosen investment aligns with individual financial goals, risk tolerance, and market conditions. Here are the most important factors. 1. Investment objectives. Clarifying the purpose of investing is essential. Objectives may include capital appreciation, income generation, or wealth preservation. Different goals influence the types of investments selected and the strategies employed. 2. Risk tolerance. Understanding one's willingness and ability to take on risk is critical. Factors influencing risk tolerance include age, financial situation, investment experience, and emotional comfort with market fluctuations. Assessing risk tolerance helps in choosing suitable investment vehicles. 3. Time horizon. The investment time frame significantly impacts decision making. Longer time horizons may allow for more aggressive investments, while shorter time frames may necessitate less volatile assets. Aligning the investment strategy with the intended duration helps manage risk effectively. 4. Market conditions. Awareness of current economic and market conditions is vital. Factors such as interest rates, inflation, and geopolitical events can influence investment performance. Staying informed about market trends helps guide decisions. 5. Diversification. Spreading investments across various asset classes and sectors reduces risk. A well-diversified portfolio can mitigate losses from poorly performing assets, enhancing overall stability and returns. 6. Liquidity needs. Understanding how easily investments can be converted into cash is essential for meeting short-term financial needs. Some assets, like real estate, are less liquid than stocks or bonds, which may impact decision making. 7. Research and analysis. Conducting thorough research on potential investments is crucial. This includes analyzing financial statements, market trends, and expert opinions. The quality of research influences the likelihood of investment success. 8. Costs and fees. Investments often come with associated costs, such as management fees, transaction costs, and taxes. Evaluating these expenses helps in assessing the net return on investment and can influence asset selection. 9. Regulatory and tax considerations. Understanding relevant laws and tax implications associated with different investments can impact net returns. Consulting a financial advisor or tax professional may be beneficial. In conclusion, considering these factors, investment objectives, risk tolerance, time horizon, market conditions, diversification, liquidity needs, research costs, and regulatory aspects enables investors to make informed decisions that align with their financial goals and optimize their investment strategies. Next important long question is: discuss various approaches for investment analysis to a prospective investor. Investment analysis is crucial for prospective investors seeking to evaluate potential investment opportunities and make informed decisions. Various approaches exist, each with its methodologies and focus areas. Here are some key approaches. 1. Fundamental analysis. This approach involves examining a company's financial health, including its revenues, earnings, assets, liabilities, and overall market position. Key tools include financial ratios, such as the price-to-earnings (PE) ratio, return on equity (ROE), and debt-to-equity ratio. Prospective investors typically analyze earnings reports, industry trends, and economic indicators to gauge the intrinsic value of a stock or asset. 2. Technical analysis. This method focuses on historical price movements and trading volumes to predict future price trends. Investors use charts and various technical indicators, such as moving averages and relative strength index (RSI), to identify patterns and market signals. This approach emphasizes short-term trading decisions, aiding investors in determining optimal entry and exit points. 3. Quantitative analysis, utilizing mathematical models and statistical techniques. This approach involves assessing investment opportunities based on numerical data. Investors can evaluate historical performance, volatility, and correlation with other assets. Algorithms are often employed to identify investment patterns, making it popular among institutional investors and hedge funds. 4. Qualitative analysis. This approach evaluates non-numeric factors such as management effectiveness, brand value, competitive advantages, and market conditions. By understanding the qualitative aspects of a company, investors gain insights into its potential for growth and sustainability, complementing quantitative measures. 5. Macroeconomic analysis. This analysis examines broader economic factors affecting markets, such as interest rates, inflation, and government policies. Understanding macroeconomic trends can help investors identify sectors poised for growth or decline and adjust their investments accordingly. 6. Risk analysis. Consideration of various risks, including market risk, credit risk, and liquidity risk, is essential for investment decisions. Investors often use stress testing and scenario analysis to evaluate how an investment might perform under different conditions. In conclusion, prospective investors should leverage a mix of these approaches for a comprehensive investment analysis, balancing fundamental and technical assessments along with macroeconomic and qualitative factors allows investors to make well-informed decisions, maximizing their potential for returns while managing associated risks. Each investor's unique strategy may involve focusing more on one approach than others, tailored to their goals and risk tolerance. Next important long question is: explain efficient market hypothesis. The efficient market hypothesis, EMH, is a financial theory asserting that asset prices reflect all available information at any given time. Developed by economist Eugene Fama in the 1960s, the EMH suggests that it is impossible to consistently achieve higher returns than the overall market through stock selection or market timing because any new information is quickly and accurately incorporated into asset prices. EMH is categorized into three forms. 1. Weak form EMH. This version posits that all past prices and volume information are already reflected in current stock prices. Thus, technical analysis, which relies on historical price patterns, cannot yield excess returns. According to weak form efficiency, price movements are essentially random, supporting the idea that future prices cannot be predicted based on historical data. 2. Semi-strong form EMH. This form asserts that all publicly available information, including financial statements and news reports, is fully reflected in stock prices. Consequently, neither fundamental analysis nor technical analysis can result in excess returns, as all relevant information is already integrated into prices. This implies that actively managed funds should not consistently outperform passive index funds. 3. Strong form EMH. The strongest assertion of the EMH claims that all insider information, as well as public information, is accounted for in stock prices. Therefore, even those with insider knowledge cannot achieve better returns than the market average. This form is more controversial as it challenges the legality and ethical nature of insider trading. EMH has significant implications for investing strategies. If markets are efficient, investors may favor passive strategies such as index investing rather than attempting to beat the market through stock picking or timing. However, critics argue that market anomalies, behavioral biases, and the presence of bubbles and crashes show that markets are not always efficient and that opportunities for excess returns do exist. In conclusion, the efficient market hypothesis provides a foundational theory for understanding financial markets and pricing mechanisms. While it has shaped investment strategies and academic research, ongoing debates question its assumptions and applicability, prompting investors to consider both its merits and limitations in real-world markets. Students, for other units explanation and other subjects quick revision or explanation links are available in description. Check out once. I think it will be useful to you. Thank you. Thank you for watching. Like and share this video with your friends.